Analyzing a company's financial health is of utmost importance to entrepreneurs, investors, and analysts. At the heart of this financial insight lies the balance sheet, a fundamental component of a company's financial statements. The balance sheet of companies provides a snapshot of assets, liabilities, and shareholders' equity at a specific point in time, serving as a crucial tool for informed decision-making. Having the ability to study a consolidated balance sheet is critical for evaluating the financials of private companies and making informed decisions. In this video, we will explore the key components, significance, and ways for effective analysis of a balance sheet. A balance sheet is a summary of the company's financials, such as its assets, liabilities, and shareholders' equity at a specific point in time. It is a vital addition to the other financial statements, including the income statement and cash flow statement, giving investors a holistic view of a company's financial status. By understanding the balance sheet, you gain insight into how resources are managed and where potential risks or opportunities may lie. At the heart of every balance sheet lies the fundamental accounting equation: assets equals liabilities plus shareholders' equity. This equation ensures that the balance sheet always balances, reflecting the principle that a company's resources are financed either by borrowing or by the owner's investments. If this equation doesn't hold, it signals errors in the accounting process, such as missing entries or misallocations. Understanding this equation is key to interpreting the balance sheet correctly. Let's look at a simple example to bring the balance sheet equation to life. Imagine you buy a house worth $50,000. You pay $20,000 from your savings and take a loan of $30,000. Here, the house is your asset, financed by a liability, the loan, and your equity, your savings. This mirrors the balance sheet equation: assets equal the sum of liabilities and equity. Such real-life scenarios help make the abstract numbers on a balance sheet more relatable and easier to understand. Let's get to know key components of balance sheets. Assets are everything a company owns or controls that has value. Assets are divided into current and non-current assets. Current assets are expected to be sold or used within a year, like cash, accounts receivable, and inventory. Non-current assets, on the other hand, are long-term investments like land, buildings, machinery, and long-term investments. Understanding the distinction between these types of assets helps you assess how quickly a company can convert its holdings into cash if needed. Liabilities are obligations the company owes to external parties. Current liabilities are essentially the liabilities that need to be met within 1 year, and these include accounts payable, short-term loans, and accrued expenses. Non-current liabilities refer to long-term obligations like long-term loans, bonds payable, and deferred tax liabilities. Shareholders' equity represents the portion of the company that is owned by its investors after liabilities have been deducted from assets. It represents the value of a company that would be returned to its shareholders if all assets were sold and all debts were paid off. This figure includes the money invested by shareholders through stock purchases and retained earnings that have been reinvested in the business. Retained earnings indicate the part of net revenue not distributed as dividends, but instead reinvested into sustaining and expanding company operations. Let us find out how to read and analyze a balance sheet step by step. The first step to analyzing the balance sheet is to assess the company's liquidity, like current ratio, quick ratios, and cash ratio. These ratios indicate how adequately current or liquid assets pay short-term liabilities. Current ratio is obtained by dividing current assets with current liabilities. This ratio, if greater than 1, it indicates that the company has more current assets than short-term liabilities. A higher ratio is generally seen as more favorable, suggesting the company has enough liquid assets to cover its short-term debts. Current ratio is useful for businesses where inventory is quickly sold, like some retail businesses. Quick ratio is calculated by subtracting current assets from inventory and dividing it by current liabilities. This is a more conservative measure than the current ratio because it removes inventory, which can be difficult to convert to cash quickly. An ideal ratio is often considered to be around 1. This ratio helps creditors and investors determine if a company can pay its immediate debts without relying on selling off inventory, which can take time. Businesses can use this ratio to assess their liquidity and take steps to improve it, such as managing short-term liabilities or converting unproductive inventory into cash. Cash ratio is calculated by adding cash and short-term investments and dividing it by current liabilities. This ratio shows a company's ability to pay off short-term liabilities, with its most liquid assets, which are cash and cash equivalents. A ratio above 1 suggests strong immediate liquidity, while a ratio below 1 indicates that cash and equivalents are not sufficient to cover all current liabilities. Here is the bonus, and it is net working capital. Net working capital is obtained by subtracting current assets with current liabilities. This is not a ratio but a dollar amount that shows the company's operational liquidity. A positive number indicates the company has enough liquid assets to cover its short-term debts. The second step in analyzing a balance sheet is to assess the company's solvency ratio, commonly used to determine a firm's ability to remain solvent. A solvency ratio is a measurement of a firm's financial health. It indicates whether a company's cash flow is sufficient to meet its long-term liabilities. Solvency ratios and liquidity ratios both measure a company's financial health, but solvency ratios have a longer-term outlook than liquidity ratios. Solvency ratio measures the actual cash flow capacity versus all liabilities rather than only short-term debt. This way, a solvency ratio assesses a company's long-term health by evaluating its repayment ability for its long-term debt and the interest on that debt. The main solvency ratios are the debt-to-assets ratio, the interest coverage ratio, the equity ratio, and the debt-to-equity ratio. The interest coverage ratio is calculated by dividing earnings before interest and taxes with interest expenses. The interest coverage ratio measures how many times a company can cover its current interest payments with its available earnings. In other words, it measures the margin of safety a company has for paying interest on its debt during a given period. The higher the ratio, the better. If the ratio falls to 1.5 or below, it may indicate that a company will have difficulty meeting the interest on its debts. The debt-to-assets ratio is calculated by dividing debt with assets. The debt-to-assets ratio measures a company's total debt to its total assets. It measures a company's leverage and indicates how much of the company is funded by debt versus assets, and therefore, its ability to pay off its debt with its available assets. A higher ratio, especially above 1.0, indicates that a company is significantly funded by debt and may have difficulty meeting its obligations. The equity ratio or shareholder equity ratio is calculated by dividing total shareholder equity with total assets. The equity ratio, or equity to assets, shows how much of a company is funded by equity as opposed to debt. The higher the number, the healthier a company is. The lower the number, the more debt a company has on its books relative to equity. Debt-to-equity ratio is calculated by dividing outstanding debt with equity. The debt-to-equity ratio is similar to the debt-to-assets ratio, in that it indicates how a company is funded, in this case, by debt. The higher the ratio, the more debt a company has on its books, meaning the likelihood of default is higher. The ratio looks at how much of the debt can be covered by equity if the company needs to liquidate. Solvency is related to debt because it's the measurement of how well a company will be able to pay off its debts. In a lot of cases, it makes sense for a company to borrow money. In other cases, it may be cheaper to take on debt rather than issue stock. In the long run, however, it is important that a company keeps track of its future obligations and whether it will be able to pay long-term debt as it comes due. Although solvency and debt are not the same thing, they are very closely related. By understanding the balance sheet and its key components, you gain the power to make informed financial decisions. Whether you're an entrepreneur, investor, or analyst, mastering balance sheet analysis helps you assess risk, spot opportunities, and ensure long-term business success. Remember, the balance sheet is more than just numbers, it's a window into the company's financial health and future potential. Thanks for watching. If you enjoyed this video, don't forget to like, comment, and subscribe.
Hit the bell icon so you never miss upcoming topics related to finance and accounting. See you in the next one.